What do you think, Kelly? Should we start and give them the mortgage knowledge that everybody is wanting today?
Absolutely. Let's do this, Chad.
All right. Well, good morning, everybody, and welcome to Unlocking Home Ownership. We are excited to have you guys here today for our first webinar. Whether you're a first-time home buyer or just curious about the process of what home buying looks like, you have came to the right place this morning. Today, we are going to hand over the keys, you get it, to help you better understand the journey to owning a home. So get comfy, grab your favorite drink, whether it's a large Mountain Dew or a big coffee, and please don't be shy in the chat. We're here to make this informative for you guys, make it interactive, and maybe even a little bit of fun. So let's unlock some knowledge together.
All right. Well, as one of the co-presenters today, my name is Kelly Cooper. I'm a mortgage banker with Dakota Bank, located in our Fargo location, and I have over 17 years of mortgage lending experience. I'm passionate about helping families prepare for that home purchase. I'm experienced in a wide variety of loan programs and products, FHA, VA, conventional, USDA, we have them all. And even the down payment assistance programs in our state of North Dakota. I'm committed to helping families build wealth through real estate. So I'm glad you're here today.
Thank you, Kelly. And everybody, my name is Chad Vetter. And as a dedicated mortgage lender, I specialize in helping borrowers navigate the home financing process with as much ease as we possibly can. I'm a proud Homes for Heroes lender, offering unique savings to our community's heroes, which is including teachers, healthcare workers, law enforcement, veterans. And whether you're a first-time home buyer, repeat home buyer, looking to refinance, definitely committed to providing personalized solutions and the best customer experience that I can possibly have to make your home ownership dream become a reality. So what we're going to do within Teams, we have a few tools that we're going to use today to make the environment interactive and allow space for everyone to ask as many questions as they possibly want. At the top of the screen, there is a toolbar where you can see a chat icon. When you click this, the chat window will open on the side of the screen. You can go ahead and type a question in there or interact with us throughout the meeting. The smiley face icon in the chat window allows for a variety of fun emojis to spice things up a little bit, and we're going to be asking some questions today, so that way you guys can throw some emojis in there. If you have questions, use the raise hand icon if you do have the questions you want to ask, or if my pacing gets a little too fast, you can definitely tell me to slow down. This is one thing I'm passionate about is education, and doing this gives people like you a lot of education and tools. So I might start to get a little too fast. So if I'm going too fast, just let me know. The react icon allows you to virtually clap or laugh or gives a thumbs up. So feel free to react throughout the presentation. So to start out, what we're going to have you guys do to make sure we're all locked in is drop 3 emojis in the chat for us that describe your dream home. So again, we're going to drop 3 emojis in the chat. So that just describing what your dream home. It could be a friendly cabin with a fireplace and a dog. It could be out in the mountains with snow, which I don't know why we would want that in South Dakota, North Dakota. It can be whatever you would like. So drop those emojis for us. Kelly, what would yours be?
I don't know. I mean, I like the one with the dog-friendly cabin and a fireplace in the mountains. That sounds perfect. We have someone else that wants sun and a beach. I love that too. So
there you go. Well, thank you guys for interacting so far.
Yeah.
All right. So today's agenda, what our goal is for today is to honestly provide insights, answer questions, and help you feel more confident and informed about the mortgage process, whether you're buying your first home, refinancing, or just exploring your options. When it comes to buying a home, this is one of the biggest investments that you're going to make in your life. So we want to make sure you are completely educated around what the process is going to be. And that's exactly what we're going to do today. So one of the most common questions we get is, should I keep renting or is it time to buy? And honestly, the answer completely depends on your personal situation. But let's walk through some key differences to help you think about whether you are ready to buy or if you should keep renting. So another question in the chat. We're definitely going to keep you guys entertained here today and engaged. So how many of you are current homeowners? Just give us a thumbs up.
Yeah, we have a few homeowners on the call today. So maybe they're ready to buy a second home, Chad, or
second home in that beach,
a rental property. Yeah. So
that beach area with the sun, maybe.
yeah, there you go.
So on the next slide, we are going to talk about buying versus renting a home. So I'm a big kind of an example kind of person. And so real life situations, and I'm going to give you an example of how much money it would cost you to rent versus to own in a 5-year window. So let's say you found a place to rent for $1,500 a month. And we're going to hypothetically say that you will be there for 5 years. So if we all do the math at $1,500 a month times 12 months times 5 years, that's going to be $90,000 that you have given your landlord to rent that home. Now, let's say you find a home in the range of $175,000. And if we do a FHA loan, just throw in, and we'll give you more examples of loan programs here later on. If we do an FHA loan with 3.5% down, and remember, there are down payment and closing cost assistance out there to help with down payment and closing costs, you would be looking at close to or a tad less than what you would be paying rent in for the above example. Now, let's say you lived in the same home for 5 years, and when we put this together, we said a rate of 6.375. On month 60, so you're having your 5-year window of renting versus your 5-year window of buying, you would have an ending balance of $160,399.80. So if you stayed at the same value of $175,000, you would have almost $15,000 to put towards your new home versus giving your landlord that $90,000 in rent. We'll go on to the next one. So how do you know if you are ready to buy? The first thing you need to know is, do you have a stable and reliable income? A steady paycheck means you're more likely to qualify for a loan and comfortably manage a monthly mortgage. And when we say steady paycheck, we're talking right at the 40 hours a week, consistently at $20 an hour, $25 an hour, versus working 34 this week, then 44, and then 36, and then 48. And we'll talk a little bit about what that could look like a little bit later on. But the stable and reliable income is one of the most important things. The second thing, are you paying your bills on time? Your credit history plays a big role in your loan options and interest rate. And good payment habits show lenders that you are responsible and you could be ready to make that mortgage payment. The third thing, ask yourself, do I plan to stay in the same area for the next 3 to 5 years? Buying makes complete sense when you plan to stick around that specific community. It gives your investment time to grow and helps offset the upfront costs of purchasing a home. And finally, and this is probably the biggest one, do you feel that you are ready for the responsibilities that come with owning a home? You have to think like things like maintenance, property taxes, home insurance. If all of those feel manageable and maybe even a little exciting to you, saying, hey, I am going to be a homeowner, then you're probably closer to being ready than you think. If you answered yes to most of these questions in regard to, I do have a stable and reliable income, I pay my bills on time, I plan to stay around, the community for an extended period of time, you might be in a really good position to take that next step toward buying a home. Either way, I always recommend running the numbers. Any mortgage lender in your area can help you compare your current rent to what a mortgage payment might look like and see what fits your goals best. Because that is one of the first questions that we always ask. What is your overall financial goal? All right, so I can take a drink of my coffee here. We're going to do a question in the chat. If you could live anywhere, where would it be? If you could live anywhere, where would it be? I really like the Colorado area, Kelly. That would be a place that I think I could live. Have a little bit of snow, but
Yeah, I agree.
just
San
beautiful
Antonio,
mountains.
Texas. We have some Black Hills, Arizona.
Black Hills again.
Yeah,
People don't like, they like
New
the no
Mexico.
mosquitoes.
You know, the great thing, Chad, is that we can help a customer purchase a home pretty much anywhere. So we can do all of these. Minnesota Lakes Country. Yeah,
Absolutely. And for the group, this is
yeah.
probably too much information, but I don't know if Kelly has this goal, but I have a goal of financing a home in all 50 states. So if somebody wants to buy a house in Maine or Hawaii or Alaska, let me know, because that would mark it off my list. All right. So the next slide, we're going to talk about qualifying for a mortgage and what lenders are going to consider. So as you can see, there's 4 different things that we are going to look at. The first one is that income. And we've already talked a little bit about having that stable and reliable income. So what that's going to include, it's going to include your salary, excuse me, hourly wages, if you get any bonuses, if you have any overtime. And the one that our underwriters absolutely love is the self-employed income, whether it could be truck driver, hairstylist, daycare providers, farmers. We look at everything when it comes to their income, whether, pay stubs, W-2s, tax returns, verifications of employment. That's how we use, or that's how lenders will use to calculate how much you could actually afford on a house. The next one, current debts and credit history. This includes your car payments, your credit cards, your student loans, anything that requires a monthly payment. They also look closely at your credit history to see how you've handled debt in the past. Your credit score helps determine your loan options and the different interest rates that are out there. So when we think of credit history, one thing that we'll look at when we pull credit is we'll look at if you have any 30-day lates, any 60-day lates, and any 90-day lates. If there's anything in collections, if there's anything that's derogatory, those are the things that we're going to look in regard to your credit history and how you've handled that. The next one, assets and available funds. This means what you have in regard to cash on hand, whether it's in your savings accounts, investment accounts, anything that you could have access to for a down payment, for closing costs, or financial reserves. Lenders want to see that you have enough set aside, not just to buy the home, but to maintain it comfortably. And one of the other things is the property. Lastly, lenders evaluate the home that you're buying. We're going to order an appraisal to ensure that the value matches what the loan amount is. If the home doesn't appraise or has major issues, that can absolutely affect the loan and how you would want to proceed with financing of the loan. All right, if you are with me, go to the chat and give me 3 hand claps. I'll just do it that way. Staying locked in for another 20 minutes. There we go. I got some hand claps. That's my 3rd grade basketball.
I think you put them to sleep, chat.
Locked in.
There we go. They're awake.
There we go. All right. On the next one, how do lenders evaluate my ability to repay? So when you apply for a mortgage, there's 2 important numbers that we're going to look at. Housing to income ratio and what your debt to income ratio is. The housing to income ratio, we'll kind of break that one down first. This ratio looks specifically at your monthly housing costs compared to your gross monthly income. So what that's going to include is your principal and interest on your mortgage, what the property taxes are, what the homeowner's insurance is going to be. And sometimes if homeowners have HOA fees or homeowners association fees, we're going to put that in that ratio as well. On the next one, that is your total debt to income ratio. This is the percentage of your gross monthly income. Again, I'm going to repeat that. Some people think it's not the gross, it's your gross monthly income that goes toward paying all of your monthly debts. So that's going to include things like that mortgage payment that we've talked about, car loans, student loans, credit card payments, any type of installment loan that you have. Any loan that reports to the credit is what's going to go into that debt to income ratio. So why those two ratios matter to us as lenders. So together, these ratios help us understand how much of your income is already committed to debt and what it's going to be committed to the housing. So that way we can assess whether you can comfortably afford a mortgage without stretching your budget too thin. A lower debt to income and housing ratio means you have more financial flexibility, and technically you would be a lower risk for us as lenders. Now, some lenders have different thoughts on this. This is kind of my personal one. When I see debt to income ratio a combined anything above 40 and the borrowers don't have a lot putting into their savings account, I get a little nervous. I've lost deals personally where on a loan we're pushing like 49% debt to income, meaning, almost 50% of what their gross is, they're going to be making it toward their payments. And I like to have borrowers have some fun in life, whether it be going on vacation or, going out and eating with a family, so that is a topic when you are discussing mortgage, ask where that debt to income aligns, and have that conversation with them. And hopefully your lender will give you those honest answers about that. Kelly, what are your thoughts on that?
I totally agree. I mean, some lenders will go higher and we can in some cases as well. And there could be additional income that we're unable to use for our loans, such as, they consistently get a bonus, but maybe we're not using it in our debt ratios too. So we do look at those compensating factors as well.
Yep, absolutely. Thank you for the add-on. So question in the chat again, what surprised you most about how debt to income affects what financial options you could get? So what surprised you most about how debt to income affects financial options when it comes to purchasing a mortgage?
I think one thing that surprises most of my customers that I visit with is we use gross income for that debt to income calculation instead of that net income. So just keep that in mind.
Absolutely. And I saw in the chat, no two scenarios are alike. And boy, that is the absolute truth. When it comes to in the mortgage world, everybody's situation is completely different. Credit score, assets, what they can put into it. And that's truly why I like what we do, because it's one giant puzzle that we have to put together in order for somebody to buy a home. Now, if you told me to put a puzzle together at my kitchen counter, ain't gonna do it. Not at all, but this is a puzzle that I do like. So before we get into credit scores, what or how many of you know what your credit score is? Do not put the number in. Just give a thumbs up if you know and thumbs down if you are unsure.
We did have a question in the chat too, Chad. Is there an estimated percentage? No, I lost it here. Let's go back. Maybe lost it here. Is there an estimated percentage that is added to that for maintaining of the home in regards to the debt ratios, I believe is what the question is. Is there an estimated percentage that is added to that for maintaining the home? It isn't. I think what we're just trying to do is we have to use those debt ratios for qualifying, but we're assuming that the rest of that percentage is for maintaining the home or for entertainment. So we don't want your debt ratios to be too high because we want you to have a percentage left over for those repairs or emergencies that come up in your household. That's why we want to keep those ratios, if we can, below 40%. Hopefully that answers the question.
Thank you. And good question.
It looks like quite a few of our people here know their credit score, so that is excellent.
Okay. Well, that is the next thing that we are going to dive into. And what is a credit score? So the first thing, we are going to look at the payment track record. This is the most important factor. I touched base on it a little bit ago, but it shows whether you've paid your bills on time in the past, meaning like your credit cards, your loans, your mortgages, and anything else that's going to report. And late payments, collections, or defaults can hurt your score and make lenders cautious. And I'm going to give you another real life example on what I ended up having to deal with just this last year. We had a customer had I think it was a high 600 credit score just coming out of college. And he thought his student loans were deferred until I think it was October is what he thought. Well, his student loans ended up having to start making payments in July. and he didn't make payments for 2 months. And so it took his credit score from high 600s to a low 600, where we couldn't use the loan program that we wanted to with South Dakota Housing. And so that payment track record, making sure that you're making those payments on time, is so important. I'm always telling people, set stuff up on automatic payments so you don't even have to worry about it getting paid. If you have a credit card, make the payment, at least a minimum payment on automatic payments, so that way you don't have to worry about it. The next thing that goes into the credit score, amount owed. So this is going to reflect how much debt you currently have. So lenders look at your balances compared to what your credit limit is, especially on credit cards. So if you have a $10,000 limit and you have $9,000 on there, that is, we're going to look at that. Or if you have a $10,000 limit and you have $500 on it, that's going to reflect better than what it would if there was the $9,000 balance. Carrying high balances relative to your limits can lower your score because it suggests that you might be overextended, meaning you're going to be going credit card to credit card, and not being able to get ahead and make those payments and get that credit card balance down. The next one, length of credit history. What this is going to do, this is going to tell us how long you've been using credit. A longer history gives us a lot more information to judge what your habits are going to be than somebody that's just, coming right out of college and they just got a credit card because they got offers in the mail. They get 13 a day, it seems like. And they open it up and they use it for a month and they think they have a credit score. It might not be the case. They're going to need a little bit longer of a history for us to be able to determine how they're managing their credit. The next one, new credit. Opening several new accounts in a short time can signal risk. So I think back to, when I was 21, 25, going to J.C. Penney's and then Herberger's and then Shields and, oh, do you want to sign up for a credit card? Do you want to sign up for a credit card? And unfortunately, a lot of people do that. And when you think of having that hard inquiry on your credit report, that can temporarily lower your score. So we want to see that you aren't taking on too much new debt too quickly, if that makes sense. But you could save that 20%. That's what they try to get you at. So, and one thing we look at is when we pull credit, there is a credit inquiry document that we look at. And if you have, 3, 4, 5 different credit inquiries on your credit report, we're going to have to get explanations of that. Some of them might not show on the credit report either, where we're going to have to get a statement and see what kind of balance you have on there. So the less new accounts in that short time frame, the better it's going to be. They also look at what type of credit. So it's a mix of credit that you might have. You might have a credit card, then you're going to have an installment loan, like a car loan or student loans. If you have a mortgage, you have retail accounts. That's just what we consider a diverse credit mix, which can show you are experienced in managing different types of credit responsibly. So together, these really paint a full picture of what your credit health is going to look like. The payment track record, the amount owed, the length of credit history, new credit, and the type of credit. So when it comes to qualifying for a mortgage, your credit score plays a huge role. Credit scores typically range from 300 to 850, and this number summarizes your credit worthiness based on your credit history. The higher the score, the more the lender will like it and like you as well. So if you don't know your credit score, you can reach out. There is some different ways to go online and look. You can go to annualcreditreport.com once a year. It's free. It'll give you all 3 bureaus as well. So those are some of the things that will go into the credit score. Next slide. What if you don't think your credit score is where it needs to be? How can I improve my credit score? So the first one we're going to say is pay down revolving debt, like your credit cards. High balances relative to your credit limits can lower your score. So keeping those balances lower definitely helps. So again, if you have a $10,000 limit, keeping it below 30% of what your limit is would be a good number. Make bill payments automatic. I kind of already touched base on that, but setting up automatic payments or reminders ensures you never miss that due date, which is going to be crucial because that payment history has the biggest impact on your score when it comes to the 30-day lates, 60-day lates, or 90-day lates. Avoid opening too many new accounts at once. Touch base on this. Each new credit application can cause a small temporary dip in your score, and too many can truly signal a major risk to lenders. And then the last one, if you're struggling to make your payments, reach out to your creditors. They often have what we call hardship programs or payment plans that can help you stay on track and protect your credit score. So now we are going to go one more question in the chat. And my son makes me play this game with him every time that we sit in the hot tub, but we're going to do it the mortgage edition. So would you rather, okay, would you rather have A, huge kitchen, B, a spa-like bathroom, C, a walk-in closet, D, a killer backyard, E, an in-ground pool? So would you rather have a huge kitchen, spa-like bathroom, walk-in closet, killer backyard, in-ground pool?
Chad, I think there should be an F where all of the above.
All of the above, absolutely. I honestly think I really like a backyard, but I would probably go with a huge kitchen because when you entertain people, that's where everybody goes.
I agree.
So I think that's what I would do. What about you, Kelly?
I think F. I want all of them, but a huge kitchen. I love having I love to cook, and our family does have a lot of gatherings with friends and family, so I agree.
All right, next one. What are the components of a mortgage payment? So when you make a mortgage payment each month, it's made up of several different important parts, not just paying down the loan itself. So here's what typically is going to go into your monthly payment. The first one is principal. This is the portion that goes toward paying down the amount you borrowed, or in essence, what the loan balance is. The interest, this is the cost of borrowing the money. If you recall, I gave an example of 6.375%. That is the interest rate that you would have to pay back on the money that you borrowed. And it's calculated as a percentage of your loan balance. Property taxes. Taxes are collected by your county. More often than not, people will escrow for their property taxes. They're often paid monthly through that escrow account to spread out the cost over the year. So when you make your payment, 1/12 of what your property taxes are going into that escrow account. Insurance, homeowners insurance, protects your home and your belongings. This is also usually included in your monthly payment through escrow. An escrow account, the way I like to explain it in case people don't understand that, is like a savings account managed by your lender. So each month, a portion of your mortgage payment is set aside to pay your property taxes and your homeowner's insurance when they're due. And each state is different on when property taxes are due. So that would just be something that you can discuss with your lender. The next one, private mortgage insurance, or what we like to call PMI. If your down payment is less than 20%, you'll likely have to pay that private mortgage insurance, which truly protects the lender in case of default. If the borrower, or if you stop making the payments, there's a higher chance the lender won't recover all of their money when the home is sold. So that private and mortgage insurance helps cover that risk. This is an additional monthly cost that you will have until you build enough equity up. And this is sometimes not HOA dues or homeowner association fees. If your home is part of a community with a homeowner association, you will have a monthly or annual homeowners association fee for common maintenance, whether it's snow blowing, mowing, or just different amenities, pool, exercise room, things like that. So when you think of all of those together, we like to say PITI, principal, interest, taxes, and insurance, plus the mortgage insurance and the HOA dues, if that applies to your situation. Any questions that we can answer so far? All right. So while your monthly mortgage payment covers a big part of what your housing costs are, the true cost of home ownership definitely goes beyond just your principal, interest, taxes, and insurance. So here are some important expenses that you absolutely should plan for. Maintenance and repairs. So homes need regular upkeep, everything from lawn care to HVAC to a leaky roof to replacing appliances. Experts often recommend budgeting about 1 to 3% of your home's value annually for maintenance. And there's been times, and I'm sure Kelly will agree, we close on a Tuesday and all of a sudden on Wednesday when they're in their home, their hot water heater goes out. That's your responsibility, or something breaks in the kitchen sink and you got to go buy something different. So having that 1 to 3% of your home's value annually for maintenance is a great reminder. The other thing, expenses, utilities, electricity, water, gas, picking up the trash, internet, Hulu, YouTube TV, whatever it might be, that can all add up and vary depending on what your home size is and your location. And all of those do not go into play when it comes to your debt to income ratio. Homeowners insurance deductible. If you have a claim, you are going to be responsible for paying your deductible, which can be several hundred to a few $1,000s. So if you have a 1% deductible, every home insurance agency is going to be different, but that could definitely add up if a case of a hailstorm comes through or a tornado or something like that. Property taxes increase because I don't think they ever decrease in Warner, South Dakota, at least. Your property taxes can go up, over time. So making sure to plan for those increases is definitely something you want to be prepared for. And then just an emergency fund. Unexpected costs happen. So having that reserve fund for surprises is absolutely critical. Owning a home is absolutely rewarding, one of the best investments that you can make in your life, but it also requires a lot of budgeting for all these costs to help keep your home comfortable and valuable. So what are some other, question in the chat, let's go this way. What are some other expenses that your current homeowners that own a home right now have experienced? So what are some other expenses that current homeowners have experienced? And I will, I'll give one, not to pick on my wife. She's not here, so I can say it. She kind of backed into our garage door, and that was an unexpected expense that we had. So that was fun.
Well, Chad, was that your fault? Did you leave the door down?
No, I was golfing.
Close it on her?
She was trying to get out too fast.
And one other thing too that we should mention when it talks about budgeting and savings, we do have another webinar that Dakota Bank presents on budgeting and savings. And I think they have that recorded, but it was some excellent material as well.
Yep, good plug in for the other Dakota Works group. All right, so for the next one, making a down payment. One of the smartest ways to save money over the life of the mortgage is making a larger down payment upfront. Sometimes that's not doable though, but let's give an example of why making that larger down payment is going to be important, because the more you put down, the less you need to borrow. So that means you pay interest on the smaller loan amount, which can save you thousands of dollars in interest over time. There are going to be several different mortgage loan options and programs that are out there that will help you reach your home buying goals with less available cash. One of the biggest myths out there is I need to get 20% down. Well, you don't need to get 20% down. If you don't want to have the mortgage insurance that we've talked on, you would like to get to 20% down. But through here, you can see the minimum down payment requirements. Rural development, you can put 0% down and tie that with South Dakota Housing, North Dakota Housing, different loan programs to get financial assistance to help with the closing costs. If you're a veteran, first of all, thank you for your service. And you can put 0% down on a mortgage. An FHA loan, that's just going to require 3.5% down. A conventional loan, depending on first-time home buyers, we could look at 3 or 5% down. And so, for an example, in South Dakota Housing, I think they have 19 different loan programs between conventional, rural development, VA, FHA, 3% loan programs to help with financial assistance, 5% loan programs to help with financial assistance. So just because you don't have that down payment, don't think it's not doable for you, because we can absolutely just have that conversation and educate you on what is out there to help you with the down payment. So just remember, if you make less than a 20% down payment, you are going to be required to carry that mortgage insurance. So some of the things that we like to talk about when it comes to saving for a down payment. The first one, that's just kind of 3 simple rules. Create a budget. Track your income and expenses to identify how much you can realistically set aside per month. A clear budget is really truly a foundation for financial success. If you need more information on budgeting and savings, like Kelly said, we have another Dakota Works presentation that we can give, or sit down with a personal banker, and have that conversation with them. Another idea, pay yourself first. Treat your savings like a monthly bill. Set up automatic transfers to your savings account before you spend on anything else. And I'll give an example of what me and my wife did. Out of sight, out of mind. This was when I was at a different location. We opened a savings account at a different bank. And I think it actually might have been Dakota Bank when we were over at Wells, because we didn't see it in our online banking. So we just put money in, and we just treated it like our true savings account that we're not going to touch. And then the one thing, it's easier said than done. Spend less, save more. Look for areas to cut back, whether it's going out for supper, subscriptions, those impulse buys when you're at Target, or Walmart, the end caps, going out and buying the $7, $8 coffees, 3 to 4 times a week. Those small changes can add up in a really, really quick hurry to help you build your savings account. Again, remember, even if you can't get to that 20% down, there are different loan programs out there. So an example that I like to give, if customers do not have a down payment, or they come in and they're saying, you know what, I got $600, in my savings account. I pay $1,000 for rent, but I want to buy a house that my payment's going to be $1,700. So if you're renting, sit down with a banker and see if they can help you plan for what would be a down payment. So I will always sit down with the renters and ask them how much they're comfortable with in a house payment. I'll take what they are paying each month in rent, so $1,000, and what a new mortgage payment would look like, we'll say $1,500, and have them save that difference for at least 6 months. So then automatically, hey, we got $3,000 sitting aside, and then we'll also be able to tell, the buyer is comfortable doing that. Or if they come in 6 months and they have now $700 in their savings account, then we know that a $1,500 payment isn't comfortable for them, and they're just not quite ready, and we'll put a different plan in place for them. So that is something that I'll always recommend, sit down with a mortgage lender, say, hey, how much would a $200,000 house be? Put that difference into a savings account and see if you can realistically do it. So another question in the chat, make sure we're all here. What's one item you'd love to splurge on for your future home? One item you'd love to splurge on for your future home. And for me, it would be whatever Starbucks has for coffee, so my daughter stops going there so much.
We have a home theater. We have a home theater, a sauna, a pellet grill. Nice.
Ooh, a sauna would be awesome. I would love a sauna.
I love it. I have a sauna. I love it.
Court, fenced in yard for dogs, maybe.
Oh, yeah.
Yep. In-ground heated pool.
Ooh,
I like it, Ron. All right. So now we're just going to kind of go through a quick overview of the steps that you're going to go through when applying for a mortgage. The first one is complete your application. You'll provide detailed information about your income, what your assets are, any debts, and we'll pull the credit for you, and the property that you want to buy. You'll work with a realtor once you do, once we give you a pre-qualification letter, and then you'll go on to searching for a home and hopefully find one, and then you'll get a purchase agreement. And that purchase agreement will, come from yourself or the realtor. And then what the lender will do is we're going to go verify all of your financial documents and order an appraisal, which we talked about, to see what the value of the home is, and preparing to close. So next one, once your loan's approved, it goes through underwriting for conditional approval. And then we may have to come back, get a few more items from the borrower, and then it goes for final approval. We'll issue what we call a closing disclosure. And that closing disclosure is a very important document, because that document has to be out at least 3 days prior to closing. Otherwise, we do not get to close on time, which is one of the worst feelings as a mortgage lender, is to not close on time, because you're not just affecting your buyer, you're affecting the people that are selling their home and potentially buying another one. We're affecting the realtor's payday. So those close dates are super, super important for us to maintain and make sure we can stay on track with that one. And then the very best one is attend your closing. At closing, you're going to sign probably 37 times. put your down payment down, your closing costs, and then the best part is you're going to receive your keys to your new home. And every mortgage banker within Dakota Bank, we're going to be with you every step of the way. If there's questions, we have a mortgage specialist, an RMS is what we call them, that will help go through different steps. That could be reaching out. We have underwriters, we have our closing department, and as we like to say, we're here for you when it comes to getting everything complete. So a couple things that we like to talk about is some tips. Be prepared. If you start thinking that you are going to want to purchase a home, maintain your documentation, whether it's your pay stubs, your W-2s, your tax returns. Provide earnest money. Usually when you look at getting a purchase agreement, you're going to put some money down. We see a lot of $500 to $1,000 when it comes to the earnest money that's provided. Employment stability is key. Don't switch jobs. If you fill out an application, in October of 2025, and you're like, I want to find a different job, let your lender know. I've had, and I'm sure Kelly has had, different scenarios where we go to, get a verification of employment a week or two before closing, and the borrower switched jobs, and they were 40 hours a week there, and now they're 32 hours a week. And if you have anything like that and you are going through the process, please communicate with your lender. Also be prepared, save versus spending, so that way you can put a little bit more money down to pay a little bit less interest. We've talked about being mindful of credit pulls when it comes to, applying for all those different credit cards. And then the last one, just communicate. That was one of the biggest things that I learned early on. The more you can communicate, the better it's going to be. So the other things, be patient, avoid opening or closing bank accounts, switching banks, transferring money from one bank to another bank. That's just going to be a little bit more stressful of a transaction for you and the lender, because we have to be able to source where all that money is going. Avoid large bank deposits. When we say large deposits, we're talking, like we'll look at something where it could potentially be a loan that you took out, and it's a $30,000 deposit. I just had one actually today where they had $30,000 deposited. It was gift money, but we had to know where that money came from. And the parents didn't want to sign a gift letter. Avoid changing jobs like we talked about. Avoid major purchases. Now, scenarios happen where your car gets hit and it's totaled and you need a new car. So stuff like that, if it has to be a major purchase and you're going through the process, communicate with your lender. Again, communicate. Avoid opening new lines of credit when it comes to credit cards, personal lines, anything like that. If you have to, reach out to us. So the bottom line really is, if you're unsure that something could affect your mortgage, just ask us, and let us have that conversation. A quick phone call can save a really, really big headache later on down the road.
Chad, there's a question in the chat. Do my purchases that are done through a firm and Afterpay have to be included in my debts? That's a fun one.
You want to take it?
I can. Yes, that's becoming more of a hot topic with our investors. And we do have to verify those debts, get a statement for what's owed, and they may definitely have to be included. So be careful with those pay or buy now, pay later programs, because we're going to look into those. So
yeah, absolutely. Good answer for that. And
great question.
I just had one yesterday. We had a mortgage loan assistant going through bank statements, and they had like 6 different payments to a firm. A firm doesn't show up on the credit report, so we're going to have to do we're going to have to do a little back end work to see what balances she has on them, what the payments are going to be. And so yes, they definitely affect what we look at. And to give you an example with it, let's say your debt to income is 49%. Okay. And we obviously do not like to go that high, just hypothetical speaking here. But if it's 49% and you have an affirmed debt that you can't pay off and it has a $300 payment on it, and we have to add it to your liabilities, then all of a sudden you're over that debt to income requirement and we're not able to do the loan. So those things, that's why we have to go through everything with a fine tooth comb and make sure that there's no other additional debt out there. So how can Dakota Bank help? As a fair and responsible lending leader, we're going to help you find, financing for your immediate and long-term home financing needs. Again, that's just a conversation that we have on what your ultimate goal is. Dakota Bank mortgage bankers are going to help you understand the different loan options that are out there, explain the benefits of different loan programs so you can make that informed decision. And I truly believe having a sit-down conversation with that lender is going to truly open your eyes and see what you can do versus a text conversation or an email conversation. So one more question. If your dream home had a welcome mat, what would it say? Home sweet home, welcome-ish, shoes off, wine poured. What would be the welcome mat?
And while our attendees are responding, we did have another question in the chat regarding credit card debt. If you have credit card debt to pay down to get more in line with the requirements of that mortgage, is there a good time that the bank wants to see that lower debt to income ratio sustained, or is it rather quickly acknowledged? So credit card debt is a little bit more difficult because it's considered a revolving debt, which means we are going to use what's on the credit report in most cases. So if you plan to pay it off, I would do it before you apply for the mortgage. And many times it maybe is a good month before, wouldn't you say? Because we want whatever's reported last to the credit reporting agencies to be what we see when we pull that credit report. And sometimes it takes a while. Sometimes they don't report. I've been told they report on the 5th of the month. I'm not sure if that's completely accurate, but if you wanted us to use a zero payment on that credit card, I would make sure it's paid off well in advance of us pulling that credit. So do you have anything to add on that, or?
Yeah, we'll look at what that minimum payment is if you have a balance on it. And that's what we have to include in the debt to income. So if you can have it paid off before you apply, like Kelly said, a month before, that would be fantastic. So I know we're three minutes over, and I think there's a couple more questions in the chat, isn't there?
Yeah, what is the turn time from purchase app to closing typically? I would say normal 30 to 60 days. We like 30 to 60 days. We can obviously do them quicker, but there are some timelines, like Chad said, where we need 3 days to disclose the CD. We need to order an appraisal in most cases. And so we need to give those vendors that are associated and those third parties time to do their work as well. We need title work. So, Dakota Bank team is excellent. Our processors and underwriters do a great job. But we do need to give those outside parties a little bit of time too in most cases. So 30 to 60 is typical. Do I want to keep going to the chat, or you want to continue with the slides? Okay. How should a borrower get some credit history if they don't have any?
I'll take this one, Kelly, if you're good with it. Yeah. So my son's fiance went through college, didn't have any credit. She graduated, still no credit, and eventually they want to buy a house. And so I got with a Dakota Bank banker. We got her a secured card. It's a $500 limit. She's using it monthly for gas and groceries, and she's paying it off every single month. And they're not looking at a house right now, but by the time she'll eventually have that credit score up there through that secured card. And I think it was Eric Marnett that helped her do that. Would be a great option for people that don't have any type of credit.
Yeah, and I think the biggest thing that we want everyone to know is that it's not like buying a bag of chips at the grocery store. This is a long-term investment. So sometimes it takes a little bit more time to save or to build that credit. And those are all important things. And maybe we need to visit with a mortgage banker well in advance, which we are absolutely, here for you on that. We'd love to visit with you if your plan is to buy a house in a year. Now's a great time to start that conversation. So
great plug again for Dakota Bank. Here for you.
Here for you.
All right. So again, here's my contact information, Kelly's contact information. Write them down, email us if you have additional questions. We would love to have conversations with you guys and just help educate you, when it comes to the home buying process. So there is also a QR code on here. If you want to take a picture of that, go ahead and do that for us. That just kind of, goes to our mortgage site and the mortgage banker directory. So that way you can, if you're in Bismarck or Fargo or Rapid, you can look to find the right mortgage lender for you. So, and if you're not sure where to start, reach out to Kelly or I. We're always happy to assist you guys and get you connected with the right people. So other than that, feedback is always appreciated. Here's a link to go on to Survey Monkey. If you can take a couple minutes to provide, your honest feedback on today's session. Feedback enables us to continue to evolve, continue for me and Kelly to grow, in our presenting skills. We would love any feedback that you do have. And if there's no other questions in the chat, we really appreciate you guys taking time out of your day to learn a little bit about the mortgage industry, what all goes into a mortgage, and have a great rest of your Friday and have a great weekend.
Thank you.